Good afternoon and good morning in other countries. Today we are having a conversation with Graham Wright, founder and group managing director of Microsave Consulting. In this series of conversations with microfinance contributors, of course, Graham was modest in saying that he can't be put on the same pedestal as Ila Ben and Vijay and called a legend. But certainly he has contributed to the broader financial inclusion sector in India, in Asia and Africa, and a lot of work he has done. And Microsave itself as an organization has contributed a lot, and from time to time we draw a lot of support and assistance from them as an organization and as individuals there. And in that way, I can confidently say that Graham Wright has been close to the Indian microfinance sector for the last 2 decades and more. Graham, I would like to just start the conversation asking you as to how exactly you got started with all this involvement with the financial inclusion framework or the sector.
Thank you, Satishji. I'm very, very honored to be part of this series. That's a really good question. I was a chartered accountant in the UK and a management consultant, and I'm now reformed, you'll be pleased to hear. And I made the decision to go and volunteer in Bangladesh back in the late 80s, and I got stuck there. And so many interesting things were going on that I actually spent the next 8-9 years in Bangladesh working on what was essentially microcredit there. And my chief lesson in Bangladesh was that savings as well as credit are really important for poor people. And I had the privilege of working with Stuart Rutherford extensively in Bangladesh, and he remains one of my great gurus. But I also had the pleasure of setting up what is now known as Bureau Bangladesh, which is about the 4th largest MFI in Bangladesh. And we started from the outset with a principle that people should be able to get access to their savings. And the regulatory regime sort of broadly allowed that, or at least didn't prohibit it. So we set up Bureau, and it grew pretty quickly and had an impact on Grameen Bank in the Tangail district where we set up, because the Grameen Bank members started agitating for access to their savings as well. As you know, the traditional old Grameen Bank model had these compulsory savings that were built up over time and then were only paid back to the members when and if they left the organization, which was a very weird way of doing things, particularly since the Grameen Bank actually really did have a license to take deposits. And of course, ultimately, if you only give people their savings back when they leave the organization, you're essentially encouraging people to do precisely that, to leave the organization to get access to their savings. So we work with Bureau offering a range of savings services, sort of current account, immediate access savings, as well as what is known in Bangladesh as deposit pension schemes, which essentially is a recurring deposit product. And alongside that, offered the traditional microcredit. And as I say now, that required a lot of really detailed process work to ensure that everything was really done on a robust manner. And you know, we ensured the sanctity of the deposits that we were taking. But Buro is now the fourth largest MFI in Bangladesh, and continues to go from strength to strength, and it's something that I'm very proud of. But that the importance of savings, I think we still tend to underestimate, because they generate less income for organizations, but also very often regulatory regimes prohibit it. But Bangladesh is a monoculture when it comes to financial services for the poor. They essentially offer only joint liability group-based products. And I naively thought that that was the only way you could service the poor. And so I really needed to learn more. And I made a decision with a heavy heart, because by that stage, I had married my wife, who is Bangladeshi, and I love the country dearly. But we decided that we had to move on in order to broaden my experience base and contribute more to the sector globally.
So then when you're taking off from that, how exactly you went about the other alternative approaches to financial inclusion?
Yeah, so I found myself in the Philippines.
Okay.
In a very remote area, in a tribal area up in the Cordillera Mountains of the main island, Luzon. And I learned there that, first of all, the realities of the poor in very remote rural areas, and secondly, that non-JLG joint liability group models can be successful. So when I say remote, I mean, you know, it was 12 hours drive from Manila, and we were regularly cut off by landslides. And when I say cut off, I mean not just access to the internet and telephones, but also the roads were cut off, the electricity was cut off, and during El Nino, even our water supplies dried up. And I remember going from house to house around the little village that I lived in, begging water from the neighbors. And that was a really good lesson. I've been brought up in a privileged family in the UK, and to learn what, you know, remote rural life is really like was, I think, a fantastic lesson for us. Quite a hard one, but nonetheless a really good one to learn. And then on the alternative models and approaches to providing financial services, we set up what Indians would recognize as self-help groups, what we call savings and loan groups, and linked them to the local cooperatives. And that, as you know, many people in India will know, self-help groups, to get them up and running and sustaining effectively, requires a lot of hard work and training them to keep their books and records right and so on. So that was a really, really interesting and important part of my experience. And I must say, I really enjoyed it, but I don't think my wife was too sorry to leave the remote area we found ourselves in when we moved on.
Okay. Then after Philippines, then where was the next move?
Next, we went to Uganda.
Okay.
And there the key lesson, you know, I mean, obviously Africa is a very different environment, but it was at that stage that the lessons I'd begun learning with Stuart Rutherford about putting the client at the center of product and process design and also the need there for local knowledge, language, and cultural understanding was really driven home. So it was in Uganda that we set up MicroSave, specifically because, again, Uganda was a microcredit-driven market. And we rapidly learned that product design was a problem on the credit side as well. So we found situations, talking to customers, we found situations where they were being lent money for just 4 months. And of course, as the volume of the loan went up, so the repayments went up because the MFIs were not extending the repayment period. So after a while, it became impossible for the borrowers to repay effectively because the installments were simply too big. That's really basic stuff, but these MFIs had not seen that simply because they hadn't been talking to their clients in enough detail, perhaps. So we developed a suite of tools which we called market research for microfinance, and it combined participatory rapid appraisal with focus groups to really, I mean, it's largely the precursor to what is now known as human-centered design. And those tools allowed us to understand the client's needs, attitudes, perceptions, and behaviors in a way that I don't think at that stage the microfinance or microcredit industry had begun to think about. So I think they were quite important. And we found ourselves asked to conduct training to build local capacities in these tools and a series of other ones we prepared on process mapping and strategic business planning and marketing and staff incentive schemes and so on. And so we were constructing these toolkits in order to then use those toolkits both for our staff to deliver, but also then to build the capabilities of our partner organizations. And this is really key to MicroSave Consulting's approach. There's one thing that I passionately believe that I worry is a problem, particularly in Africa. There's still way too much of parachuting people in from America or Europe to solve the problems of the local market. And those people don't speak the language. They don't have the local knowledge. They don't have an understanding of the culture. And so a lot of their advice is limited because of that lack of understanding. And I would like to see the development community spend a lot more time building local capacity and capabilities rather than just flying in Videshis like me, foreigners like me. And so if you look at the organization, MicroSave, 98% of our staff come from the countries that we're working in. And that's sort of, as I say, core to our belief system that this should be a South-South development approach. And our job is to empower and facilitate local people to solve their problems. Now in India, you've got such a rich, deep talent pool. I don't think that's as big an issue. But in Africa, there's just an endless procession of fly-in, fly-out consultants. And there was, when I was in Bangladesh, it was exactly the same. And very often you had these foreign consultants who understood less about the fundamentals of microfinance than the people they were advising, which was absurd, absolutely absurd. And understandably, many of the Bangladeshis got very fed up with this. So that's something that we've been working on over the years and continue to work on, making sure that local people solve local problems simply because they have a better understanding of those problems and how to address them.
Graham, again, going back to Philippines for a couple of minutes, because in Philippines, since you worked with the what we call as the self-help group model, and of course, what we know is that the first models of this self-help group type of activity were in Philippines and also Indonesia, where they then GTZ supported. But both in Philippines as well as Indonesia, the SHG model didn't succeed as well as in India. What are the reasons in your assessment for that?
That's a really good question. So first of all, I should say in the Philippines, I was in a very specific remote area. So I hesitate to talk about the rest of the archipelago. But I would say that in that remote area, they work reasonably well because the community was so tight. Outside, in less remote communities, better connected communities, maybe that they are less tightly bound and there's less social capital on which to depend. I don't know. I do remember doing a study of ROSCAs in Uganda, these rotating savings and credit associations, so savings clubs essentially. And we asked people to talk about the size of ROSCAs over time. And they had declined over the last 20 years, and obviously you're doing recall in that research, and that has limitations, but people were consistently saying 20 years ago, the average size of a ROSCA was 15 to 20 people. And now the average size of a ROSCA is 3 to 7 people. So I think that the circle of trust is declining as communities begin to have more access to the outside world. And I have, SHGs depend a lot on those circles of trust. So that may be one of the issues. The other issue, I think, is in India, they were embraced at a national level and driven as a sort of part of policy, both by NABARD and the state-owned banks. And I'm not convinced, and I don't know the evidence of that happening in the Philippines or Indonesia. I don't answer the question, Satish, but those are my guesses.
Then Graham, I think after Uganda, your next move was to Kenya. Then what exactly happened there?
In Kenya, Kenya, which is just a gorgeous country to live in, we were so privileged. In Kenya, we saw two really important things. First of all, the power of banks that are focused on down market, as well as maintaining their relationships with the higher net worth people. And I'll talk about Equity Bank in a second. And then secondly, of course, Kenya is home to M-Pesa, and I was privileged enough to sit on the steering committee of M-Pesa when it was first being set up, and realized that the digital revolution was coming and that this is what the future was going to be. So we moved from Uganda to Kenya because Kenya is the regional hub, and I was just constantly living in Nairobi airport, and I got a bit tired of that, so I thought better to move to Nairobi. And there we had this program where we were working with a wide range of financial institutions, from MFIs to banks, to make them more market-led in their approach, more client-responsive in their approach. And that took us to Equity Bank, who came to us when they had 109,000 customers back in 2001. And we worked really closely with that bank. In those days, it was a building society, and we strengthened its processes, strengthened its risk management, worked on its strategic business plan, its marketing plans, and so on, and helped them build, refine and build a new suite of products. And it just took off because it was the only bank that was serving both the bottom of the pyramid, the middle of the pyramid, and indeed even some of the top businesses in the country. And it just catalyzed change throughout the Kenyan market. And now it has, I mean, it operates in 5 or 6 different countries across Africa and has 13, 14 million customers. And it is also now a fully digitally transformed bank, so that more than 90% of its transactions occur outside the branch network. So that has extraordinary implications both for the cost structure of the bank and indeed the way the bank operates. So what it means is that branch staff are largely about helping manage the agent network and helping customers manage their, choose their products and manage their wealth. So they're no longer tellers counting out cash. They are now wealth advisors for the customer base of Equity Bank. And the lending is digitized, the repayments are digitized, a lot of the savings is digitized, so that poor people can do their banking over their phone from the comfort of their own homes. Or if they need to get cash in or out, there is an agent relatively close to them. And if anyone ever gets a chance to look at some of the reports on what this bank has done, it's jaw-dropping. It is just extraordinary and really exciting. And it was a real joy to be sort of part of helping the bank establish itself, list on the stock exchange, and then do this digital transformation. And of course, that digital transformation has been powered not powered by, but driven by the success of M-Pesa. Equity Bank had to set up its own systems, and it has its own mobile network system. And it had to do that because M-Pesa was just dominating the mobile money market in Kenya. And so that's what drove the change and the digital transformation of Equity Bank, and indeed other banks in Kenya. And M-Pesa is extraordinary. I mean, there's no question about it. The vast majority of Kenyans not only have M-Pesa accounts on their mobile phones, but use them on a regular basis. And, Kenya in that respect is a leader. I worry that everyone talks about M-Pesa and the mobile money rather than talking about the digitally transformed banks, and particularly Equity, which is at the cutting edge of that. Because as we know, in India, for example, the central bank is concerned about non-banking entities driving too much of the financial service revolution. But Equity Bank is a real bank, supervised by the Central Bank of Kenya, that is a fully digitally transformed bank, and is quite extraordinary. And to have achieved that in Kenya rather than in Sweden or or the UK is in of itself extraordinary.
That's true. That's true. Graham, in talking about Kenya in late 90s, when I was in our Bankers Institute in Lucknow, we used to interact with the Kenya Rural Enterprises Program in Kenya, which was later transformed into the KREP Bank also. But later we don't know much about its progress or how much it has really contributed to financial inclusion and all. So it appears that it lost its way somewhere.
Yeah, I think that's right. It had so much potential, and it showed the way on so many issues. But there are many of us who worry that Kimathi Mutua, who used to head it, who is an absolutely inspiring person, was put on the pedestal by the sort of donor community way too early. And so what happened was he was constantly on the road talking about KREP Bank rather than focusing on getting the work done and building the bank and so on. And so when some other organizations like Equity Bank started to really address the bottom of the pyramid, they did it with so much more focus and I suppose aggression almost, that KREP fell behind, and that was really unfortunate. But that's the reality, and with all of us, we have to be very careful not to believe the hype around organizations and get carried away. We have to be humble and keep working and doing, keep looking to improve and move with the market, because particularly with the digital revolution, everything is changing so quickly that if any of us pause to rest on our laurels, we'll find, competitors speeding ahead.
Yeah. No, that's what that they say about, that's what happened even to Mi Banco in Peru, or some of other banks also there, because they did not give sufficient attention to the governance, implementation, business development, and all. Then Graham, of course, you had a good involvement in India. Then after working in Africa, then what exactly brought you to India, and what all you were able to do for the Indian microfinance sector?
Well, I can tell you what brought me back to India, which is a deep love of the Indian subcontinent and all the extraordinary culture and the amazing people that are in the Indian subcontinent. The initial conversation came from a colleague at DFID, as was then, and he said, "Look, what you're doing in East Africa, you should try and do in India, because it's at a tipping point, at a moment of change." And this was in 2005 or so. So I went across on a sort of exploratory mission, and Brij Mohan, who, as you know, is just an absolute inspiration for the JLG movement in India, and Vijay Mahajan were kind enough to encourage me to come and see what I could do to help at all. How much I've really helped, I don't know. As I say, there's so much talent in India that I always am consistently humbled. but it taught me a lot. India has taught me a lot. I think, you know, initially, within a few years of my arrival, nothing to do with me, the AP crisis happened, and we saw the dangers of exponential growth, and particularly when it's sort of virtual VC induced, you know, and there's the promise of an IPO, and you know, people will cut corners on what they're trying to do, you know, how they're trying to implement in order to turbocharge the growth. I also learned a great deal about how government can catalyze change. The Indian government is really seriously concerned about and invests in addressing poverty-related issues in a way that you don't see in many other countries. Most don't have the resources to invest in anti-poverty measures, and very often the commitment is very strong during election times and considerably less so once the election has passed. So if we look at some of the things that the government has done to catalyze change within India, we've got the small finance banks and the payments banks. That, I think, was game-changing in many respects. I come back to the importance of savings and a range of financial services for poor people, and creating small finance banks allowed the leading microcredit organizations to start offering that range of services. Then the second is the whole Aadhaar and G2P revolution, which has really brought people into digital financial services and financially included them. Then we've got the extraordinary payment systems, a range of payment systems that MPCI have been establishing, particularly the UPI, which is, you know, tremendously impressive. And then, of course, we've got the fintech revolution that's underway in India, and we're privileged to be working with the Indian Institute of Management, Ahmedabad, on that with our financial inclusion lab. And again, I mean, all of those are largely driven by the government and regulators catalyzing and encouraging change. And I think that that's an extraordinary approach, and one that really sets India apart from most other countries. You know, years ago when I first arrived in India, I predicted the formalization of MFIs, but I didn't see the implications of it. And, you know, I think the writing was on the wall for the Andhra crisis a couple of years before it actually hit. And that was then turbocharged by the rush to IPOs. And, you know, I mean, some of the MFIs that we did strategic business planning with and so on were very geographically concentrated in exactly the wrong place in AP, and you know, are still rebuilding even to this day. But recently we've been working a lot with the government on Aadhaar and then the direct benefit transfers, and also with MPCI on the payment systems, because together those are what will enable poor people to become financially included and also begin to use digital systems. The long-term game is going to be to ensure that everybody has an opportunity to participate in the digital revolution and benefit from the digital revolution, because it's going to impact health, it's going to impact agriculture, it's going to impact so many really important parts of poor people's lives. And I think we'll talk about this in a little while, but my biggest fear is that we'll have a digital divide, and that poorer people living in more remote areas won't get access to all the potential benefits of that digital revolution, and better off people living in less remote areas that are better served, will benefit and will advance significantly. And that digital divide will exacerbate the poverty of the bottom of the pyramid.
Graham, when you're talking about this digital divide, and one thing, because since you have worked in Kenya also, that one thing which strikes as far as India is concerned is that though various forms of digital finance has become popular, and even now we see even what I couldn't imagine a couple of years back, a small vegetable vendor on a cart, he is ready to accept a Paytm payment, which would not have been really, we would not have thought even a couple of years back. But the mobile revolution has not really happened in India the way it took roots in Kenya. Though there was a lot of expectations, and even M-Pesa started working here and all. What could be the reason in your thinking or assessment?
Yeah, that's a really good question, Satish Ji. There are two or three things. I think, first of all, we have to bear in mind that M-Pesa is largely on a basic feature phone. So it's not USSD driven, but SIM toolkit driven. So it doesn't require a smartphone. Whereas most of the UPI-based systems require a smartphone, whether it's a QR code or whatever. In the main, they require, as a bare minimum, something like Jio's, smart feature phone. The second thing is that we should not lose sight of the gender dynamic of the digital divide. And we know that throughout the Indian subcontinent, many communities frown on women having mobile phones because they believe that they'll somehow misuse them, shall we say politely. And so not only have we got a situation where a very substantial proportion of people in India don't have a phone at all, there's another substantial proportion of people that have a feature phone, and only about, I think it's around about 50%, and I'm sure people will challenge me on that, but around about 50% of people who have smartphones. But if you did that analysis for women, you would find many, many more without a phone or with just a feature phone. So I absolutely agree with you that I think the progress that has been made is extraordinary, but comparisons with M-Pesa are not entirely valid because of M-Pesa's feature phone driven systems, and also both men and women in Kenya are more likely to have a phone.
Graham, now when you talk, if you talk in terms of the institutional infrastructure or architecture, we have microfinance institutions in India or elsewhere and all. Do you feel that going ahead now, in India also we have seen bigger MFIs transforming into banks and small finance banks. At a certain stage, there would be a necessity for the pure MFIs to work just as agencies or as business correspondents, rather than being just standalone and independent institutions. Because as you also have been saying that credit is not the only financial instrument which the poor need. They also need savings. That a standalone MFI can't do. Probably it could do if it is in an agency form linked up with a regulated bank. What do you say for this? Not only, of course, in India, but overall across the globe.
Yeah. So I think MFIs are, on the face of it, well set up to act as agent networks, as you say, for banks or other providers. The issue will be how to optimize revenue flows for the MFI, because the business case for pure agent network management, particularly in India, where the commissions that a government pays on transfers is set at just 1%, as opposed to the 3.14% recommended by the Sa-Dhan committee. And we at MSC have reanalyzed that, and we came to 3% as well. So it's not an easy business model. And I think MFIs want to try and get a hybrid of, if they go this route, want to get a hybrid of acting as agents for the products that they're not able to provide, and to provide some of the credit, at least, off their own balance sheet. Now, how you engineer that in the agreements with banks and so on, may be complicated, but I think it's important. But I think with the digital revolution comes an existential threat to MFIs. And that's because in those areas where people are better off and better access to a range of digital services through smartphones, they are going to have digital footprints and data in their digital lockers that will allow fintechs and digital lenders to make well-informed credit decisions and tailor products specifically for those people. That will leave MFIs servicing only those who don't have access to a smartphone and live in more remote areas as their core clientele. And that is going to be much more difficult to break even, to build a business case around. And that's why I think MFIs will have, all those microcredit organizations will have to think very hard about their business case and their strategy moving forward, because the market in 5 years' time will be awash with digital credit lenders leveraging data in the, built in the digital locker that the India stack provides. And I've been warning MFIs about this for 2 or 3 years now globally. I think we will see this impact pretty soon in India. We're already seeing it in Kenya, big time, and I'm pretty sure that we will see it increasingly in India. So I think your hypothesis that microcredit organizations need to create alliances to diversify their offering is absolutely right. I think that they will also have to look at what elements of their operations they can digitize. But as a final point, we also know that less tech-savvy people really want human touch in those transactions, if at all possible. And I think there's an important role again for the MFIs to provide that human touch, to allow people to, to provide poorer people an opportunity to talk about the credit product that they're getting or the savings product that they're opening. So I do think there's a role, but I just don't think it's the same as it currently is.
Yeah, Graham, I too agree, because what we have been seeing in terms of usage of digital platforms or digital devices is that there is still a demand for a lot of assisted mode. Because even when the client, a microfinance client or even a bank client wants to do the transactions digitally, she or he would require someone to assist him. So many things like how to use the QR code, how to feed in the PIN, and how exactly to put the card, where should the chip side go and all. So probably that's something which assisted mode, and that's the reason why even the government has this program of bank sakis, which are helping the women in the SHGs or JLGs to do their digital transactions. So probably that could be the shape of what you said as a phygital mode. It's the device, the transaction, everything is on a digital platform, but human touch is there in terms of someone to carry out the assisted mode. Probably that could be the thing in near future for the microfinance sector, not only in India but elsewhere also. Finally, when you look forward, of course, your experience in all Asia, Africa, and Latin America, then what you feel are the key issues, and also what are the opportunities for the broader financial inclusion community across the globe?
Yeah, so we've touched on many of them. I mean, I think let's start with the really good news, which is that for years we have never answered the elephant in the room question, i.e. financial inclusion for what? We've always just sort of gone with the assumption that if people are financially included, it's a good thing. Now I think with the role of digital services coming to the fore, financial inclusion is a part of accessing those digital services, paying for them, and so on. And so we're able to answer that, because now we can say, yes, financial inclusion allows people to decide which school to send their kids to, make payments to that school, borrow if they haven't got enough money to pay the school fees, look for the right books online, and so on. Similarly, I can do a similar model for agriculture, where financial inclusion is important, but it's just one part of the overall role of digital agriculture. So, digital agriculture allows me to identify what given my my farm and its soil, what is the best crop, what are the pesticides I need, what are the fertilizers I need, when do I sow the seeds, and then I can then use that to identify what insurance I might need to buy, to get credit if I need credit for some of the inputs. I can also get information coming into me about imminent threats. So if the maize borer beetle is in the next door district, I will get a message from an agricultural service system that will tell me to buy this much pesticide in order to protect my crop against the maize borer beetle, and so on. So financial inclusion then becomes a subset, an important subset, but a subset of a much bigger whole that is going to have much, much more impact on poverty in the long run. So I'm really optimistic about this. I think that it has huge potential, but as we discussed earlier, the digital divide, leaving people out of all those tremendous benefits that the digital revolution is going to bring, is really worrying. And it is very important for those of us that care about poverty to think very hard about how we're going to do that. And I think that's another role, incidentally, Satishji, for agents. Agents at the moment are typically just cash in, cash out, possibly sell one or two financial products. In the longer run, they need to become a supermarket of services. Not all agents, I think we'll have differentiated agents. So we'll have the supermarket of services in the market towns, in the hats where people go to buy and sell once a week or once a fortnight. And then we'll have basic cash in, cash out agents, you know, more in the villages. But it's going to be really important that those supermarket of services agents have, you know, enable and provide the assistance for poor people to get access to the broader range of services that cover education and health and agriculture and all the real world needs that they will have, because the digital revolution really can play a role there. And you know, many, and the government of India was trying this with the community, what were they called, CDCs, the community development centers. And I think that, you know, building off the lessons from that is going to be really important. And I think the other thing, and I've touched on this one also before, is that I would love the international donor community to start thinking much, much more about how to increase South-South knowledge and capability. There are lots of technological innovations that are happening in India, but there will be ones that can usefully be imported from the developed world. But I come back to this point that local companies, local consultants, local entrepreneurs are going to drive development in these countries ultimately. And about 20 years ago, the bilaterals were pushing this, and I think we lost sight of the importance of local knowledge and capability. And I would love to see that re-emphasized and turbocharged once again.
I think certainly I do agree with you on that. One small question as a part of that, there is a general criticism, especially from people who are not from the financial sector, that the expansion of financial services, either by the banks, mainstream banks or microfinance institutions, and easing of the provision of credit burdens people with more debt than they can afford or than they can service. Is it a valid criticism?
This is a really good question. And let's go back to Kenya to look at this again. And the problem is beginning to manifest in India as well. Because it's so easy to access a digital loan in Kenya, in fact, you can access 2 or 3 digital loans simultaneously, easily in Kenya. A lot of people have got either over indebted or in some cases just took a digital loan to see what it was like. So we now have a situation where right now in Kenya, and this is obviously amplified by the problems of the COVID-19 pandemic, but 50% of the population have a Fuliza which is an overdraft loan from M-Pesa. There are literally 2.5 million people who have been put on a negative list on the Credit Reference Bureau in Kenya for not repaying their digital credit loans on time. And a lot of that is driven by really aggressive push marketing. So if I'm in Kenya and it's January, I will get tens of SMS messages saying, we know it's a tough time of year, Christmas is over, you must pay school fees, have a digital loan. And so a lot of people have got into trouble this way. And we're beginning to see this in Kenya with these Chinese digital lenders taking over defunct or semi-defunct MBFCs and driving consumer digital credit really hard, particularly at the younger community. And I'm glad to see the RBI is cracking down on that, and it's really important that they do, because what's happened in Kenya is not only are people borrowing just to, and remember, they're pretty small loans, just to sort of tide themselves over, but there's a whole significant submarket of people borrowing to do sports betting. And the younger generation in particular, I read a statistic the other day that 40% of young Kenyans think that sports betting is a way of earning a living, which is just crazy, just crazy. So I think it's a really good question, and I think we need to be really careful. So I think digital credit is an important step forward, but gosh, we've got to be careful about how it's managed and how the terms and conditions are clearly laid out, easily understandable, and also designed to stop people taking loans when they don't really need them or don't have a proper purpose for borrowing.
Certainly, I too do agree, because this client education on how to use the credit is one of the important things which we always stress on our member MFIs also, that wherever requirement is not there, you have to advise the clients only to borrow to the extent they require. Graham, it was quite interesting conversation, wide-ranging, and with your experience right from Bangladesh, Philippines, Africa, and India, we were able to discuss so many issues. And I think your inputs and your thoughts will be of quite interest and use to all the people who are interested in the broader financial inclusion framework in India. And of course, we do have a lot of interaction and support from Microsave in India that will always continue with Manoj and others there. So I thank you for taking your time to discuss these issues with us, and we hope that we'll be able to meet soon physically in India. Thank you, Graham.
Thank you so much, Satishji. It's been a real privilege.
Yeah, thank you.